Hello and welcome once again to the Smart Money, Dumb Money show. And I am your host as usual. I'm Keith Richards and I'm President and Chief Portfolio Manager at Value Trend Wealth Management. And today's talk is about sector rotation. So let's get started. I'm going to share the screen and I'm going to go right into a PowerPoint where I've just done a couple of slides. So slideshow from the beginning. Okay, it's only a few slides, but what I want to do is compare the rally that we saw during the summer of 2022 to the rally that we are going through right now. I am recording this on November the 23rd, and so far it's been somewhere near 30 days of the market having a pretty good pop off of a low point. In fact, that low point was a support level on the S&P 500 at around 3,600. So what I want to know is the sectors that are seeing that rotation, that are causing that market rally, and seeing if there's been any changes to compare the two rallies to see if there's any warning signs or anything else we should know. So let's get started. And we want to divide and conquer, as I said in the subtitle, which means I'm going to divide it between the outperformers and underperformers. Now, some of you may subscribe to stockcharts.com, and if you don't, I strongly recommend you do so. In fact, I do, as many of you know, a technical online trading course on our website. You can click on it, and there's actually a bit of a discount for people who subscribe to our newsletter. So I recommend you take the course. And if you don't have the discount code, I'm going to keep it going until the end of the month. Shoot me an info and I will give you the discount. It's good until the end of December. Okay. And in that course, I talk about a sector rotation model. Now, there's different ways we can look at sector rotations. We can try to figure out what the market's moving into, which is the way I usually use it. But we can also try to compare things like I'm doing today, which is how does this rally look like versus the last rally. So let's take a look at the summer rally, which was between roughly June 17th and August 17th. It was actually, I think, the bottom was on the 16th of June and it peaked out around the 17th of August, but whatever, about a month. And what you will notice here is that energy was the big loser. So this is a comparative relative strength. This is not an outright return. So when we see energy went down is negative 11.7% on the screen here, that doesn't mean energy lost 11.7% that month. What it means is versus the S&P's rally, like the market was up, seemed to be, it was around 10 plus percent. I try and recall how much that rally was before it faltered, but whatever it was, let's pretend it was 10%. So the energy sector underperformed that rally, implying probably it went down a point or two. So it's a relative performance. So if technology outperformed the market and the market made 10% that month, then technology probably made 13. So that's really how you read this chart. It's just a relative comparison. So what you can see here is I've circled the winning sectors, the outperformers, and there was about 4 of them, and then the losing sectors, which the big losers were energy, utilities, financials, and real estate. Okay, so let's compare that to now. So there was kind of 4 winners and 4 losers. Now, the other thing I want you to see is the extent of the winners. It wasn't huge. It was relatively well distributed rally, but there were a couple of standout losers, but really wasn't a lot of standout winners. Now let's take a look at the current rally, which began on October 12th of this recent fall rally. And as I said, it's the 23rd today as I record this, so I have data up to the 22nd. By the time you see this video, it'll be a little bit later, but you can see that the discrepancies have changed. So energy, in fact, is a winner right now. And you can see consumer discretionaries, which were a positive, are the deepest loser of the group. followed by communications. But really, you know, if you'll notice, like the distribution between the losers and winners were probably half and half. As you can see, there's, you know, 4 big winners and 4 big losers. This time, you only have like 2 bearish looking ones, which is communication services and discretionaries. A little bit down on the healthcare, but not too much, more or less in line with the market, really. There's been, you know, a pretty even distribution. There was some winners, there was some losers, and then a number of them were pretty close to at the market levels. So it's not quite as, you know, polarized, I guess you could say. But let's take a look at the observations we can make after comparing those 2 relative strength observations. So we are not comparing the market to the market. We're comparing what the sectors were doing to the market during those 2 rallies. And I mean, if the market had gone down in one of those 2 periods, you'd still see some outperforming, maybe losing less versus some underperforming, you know, losing more. So it's a relative performance. It's got nothing to do with raw performance. So what we're trying to do is compare a rally to a rally, and that's really important to understand. So during the summer rally, what did we see underperforming? Well, we saw energy, utilities, financials, and real estate. Okay. That's actually 4. I wrote 3 here, so ignore that. And then we also had discretionary tech and materials that outperformed in a fairly big way. In the fall rally, which is the recent rally, I've highlighted discretionary here, okay, because it was one, we'll talk about this in a second, but it was one of the ones that actually completely changed from being an underperformer to an outperformer. I should say from an outperformer to an underperformer. So you can see that in the summer, discretionary was one of the outperformers, okay? We had discretionary, communications, both underperforming. Remember, we just looked at it. There's the 2 of them, right? So we had those doing a lot of less work in this rally than the rest of the sectors. Now, recent rally as well, though, we've seen industrials, materials, energy, and financials moving well. So the new outperformers, the ones that were not outperforming during the summer rally, which were discretionary tech and materials, are industrials, energy, and financials. And in fact, if we go back, you can see energy in the summer rally was a very big underperformer. Well, funny enough, energy is actually a outperformer right now. Okay, you can see there's energy. So that's a big changing of the guard. All right, so the new overperformers or outperformers are industrials, energy, and financials. So there's been a rotation in energy and financials. So they were, you know, underperformers, and now they're outperformers. So the way I look at all of this stuff is I say, okay, from a common sense point of view, you want to look at where the money's going. And I'm really interested, not just in where the energy is going, which is industrials, energy, and financials, but I'm particularly interested in energy and financials because they've moved from underperformers to outperformers. So that's really interesting. Doesn't mean you necessarily go out and buy them, but there's certainly something you should be examining. All 3 of these, though, in this current rally are where the money is going. And so that's what you want to be looking at if you're going to play this rally. Now, I've written blogs, and you probably, if you're watching this video, you probably read my blogs. And I've been saying, I think this rally can last to maybe the end of the year. That's an educated guess. Nobody really knows. After that, I'm curious as to whether we get another leg down. And that's just a curiosity. But if I had a gun held to my head and somebody said, I'll pull the trigger if you're wrong on this guess, then I would guess that we will get a leg down after the rally ends somewhere near the end of the year or the first week or so of January. But that's just an educated guess, and you're holding a gun to my head here. So my thoughts are that for the rally, the time being, it's clear industrials, energy, and financials are getting the money. And so if we're going to play this rally, whether we stay with it or not is another question. That's more of a market question. But if we want to stay with this rally for the trade to the year end, then we want to have at least some sort of concentration in those three sectors, with maybe a little bit of interest in energy and financials. But that's up to you, because it comes down to looking at the charts first. And I have been discussing energy a lot lately because it has been a little bit underperforming in just the past few days at the time of recording. So the past month, it's been an outperformer, but not necessarily the past week. So anyways, those are the three sectors that I think we need to look at for this rally. And really, that's the way I always look at things. I'm not trying to figure out what's going to happen a year from now, because so many things happen in a year. But I am trying to figure out what might be, based on the macro look of the market, what might be the place to be for at least the next target that I have in the market. And so those are the three sectors that I think are the places to look right now. Thanks for watching. If you have any questions, as always, you can post them to my blog. Please don't send me inquiries to the info@Value Trend. If you want to send me an inquiry regarding portfolio management, then you use the info@. But if you want to make a comment regarding this video or my blogs, you usually go to my blog and put a comment in the comment section. So I appreciate that, because it is a community effort. We're trying to keep everybody involved, and I will answer your questions right on the blog. So hope that helps, and we'll see you in a week.